hard realities of a soft landing. Jay Powell warning Congress today that steep rate hikes could tip the economy into a recession, but stocks held in there pretty much as investors have assumed as much already and were reassured that the Fed will do what it takes to bring down inflation. So given today's action on the back of yesterday's rally, is the market finally showing real signs of stabilization? Let's ask Josh Brown, co-founder and CEO of Ritholtz Wealth Management and the CNBC contributor. Josh, great to see. I'd love nothing more for you to come on and say, absolutely, the past 2 days tell us this market is on firmer footing. The hard times are over and we're ready to run. Guessing that's not the case, but what is your takeaway from some of the action today, both in stocks, holding on to a 2.5% rally from yesterday, and then, bond yields softening up, oil rolling over a bit?
Well, I think what you just finished with is the most important thing. If the trauma that we've been through so far this year originated in the bond and commodity markets, then any reprieve we get from there should be the basis for at least a meaningful bounce. I don't want to say full recovery and give people the wrong idea, but think about it. We're now looking at WTI crude below the 50-day moving average. Nationally, gasoline prices have gone down for 8 straight days. That should be very helpful, not just for sentiment, but for real costs in the economy. And it's a nice reminder for people that nothing goes straight up or straight down. And then I would say the same thing with bond yields. We can still have a high inflationary environment where at some point bond yields give us a little bit of a break. And that's what we're seeing. And I think both of those things combine with the extreme oversold readings that we had in the internals, which I know you're well versed in. And when you look at those things in concert, you say to yourself, okay, there's a lot of bad news. It's tough out there. It might be even getting worse. But is there anyone left who hasn't recognized that? The Fed is now talking openly about the possibility of recession. Elon Musk and Cardi B, it's like, is there anyone left to find out that maybe we're going to have a recession? Probably not. So this is really where we are at this point. I don't think people should get too comfortable, but I do think people should just accept this idea that they need to be open-minded. And being open-minded put you in a position yesterday and today to enjoy some reprieve.
Yeah, and no, it's a totally fair point. Obviously, we're burning off some of that oversold condition that you probably should. I mean, at this stage, I agree with you on that. And it's interesting because being open-minded and kind of deferring to the fact that maybe the trend is what it is, but it's not going to be in a straight line. I think we just have to flip over 180 degrees what was going on last year, which is, why is the market going up today? Well, same reasons as yesterday, mostly. It's the ongoingness of the Goldilocks type scenario and the profit growth. And today it's, why is the market struggling or why is the market a bit stuck? Well, it's really the persistence of the same issues. And this time it's been be ready to sell the rallies as opposed to be ready to buy the dips. What would you be looking for, though, for a sign that it wasn't just that not every single rally was suspect?
Well, that's a great question. So if you are fundamentally oriented and you're trying to do asset allocation based on where prospective returns and prospective opportunity are coming from, then you're not so much worried about what has momentum at the moment. And the good news is the trauma that I referenced has created real opportunities, and not just ephemerally speaking. In hard data terms, Urian Timmer has a chart up today looking at profitable companies in the Russell 2000. So let's take the IWN ETF as a proxy. That's the Russell value, small caps, obviously, very economically sensitive, of course. Not a ton of large cap tech or work from home in there, but real companies with real earnings, real dividends. The valuation, first of all, the price level has now blown through the pre-pandemic period of time, which probably doesn't make a ton of sense unless you think this economy is worse than the economy of March and April 2020. I don't think most people do. But valuation-wise, Mike, you can now buy those companies at a sub-10 PE. So for all the talk we had about how overvalued stocks were and how big of a bubble the Fed blew in valuations, there are huge swaths of the market where there are plenty of stocks that don't look anything like that environment that people had been describing. So I think you can look at that and say, all right, I get it, tons of volatility, but tons of opportunity. I'm willing to eat a lot of the former in order to have a lot of the latter later on. And then the last thing I would say, you know, the stat that you keep hearing people say on CNBC and elsewhere about this being the worst start to a year since 1970, well, what happened after that? Fast forward 4 quarters from that first half of 1970, and the S&P 500 was up 27%. So, and you go back and look at any first half, and I think we've had probably 6 or 7 first half periods where stocks declined more than 20%. None of them were losers 12 months out if you bought during those periods of time. So that's why being open-minded, even if you accept that we're in a bear market recession, that's why it's so important.